Hello everyone, welcome back. It's Fung here again. Today we're going to be talking about how to diversify your portfolio. And again, the information here is sourced from the book The Truth About Money by Rick Edelman. So getting started, right? How does diversification work? Well, first, you're going to want to split your money into different asset classes. Right. In our previous lessons, we talked about how every asset class has its own risks and that you would want to diversify so that you can mitigate the risks of each one, right? And sometimes they can cancel each other out. So we'll do an example here. Let's just say we have $100,000 to invest in, and that we're going to do a 25% split into cash, government securities, corporate bonds, and stocks all equally, right? 25%. So let's take a look of it. So our initial here on the left is just putting 25%, right, in each one. Then after some time, clearly, right, as we know that the stock market has an upward bias and it also grows money pretty fast, that the stock market's going to outperform your other ones, right? Your other asset classes. And this is what the pie is going to look like in the middle, right? That's your portfolio here. So then you're going to want to reallocate it, right? Because now your proportions are off. You wanted that 25% of each. So now you got to move it back to 25%. So what do? You sell some of your stocks, sell a little bit of your bonds, and then buy more of the others that are lacking. And now you're probably thinking, why in the world am I selling what's doing good and buying what's doing bad? Well, the thing is, if you sell the winners and buy the losers, right, it sounds crazy, but if you constantly sell winners and you constantly buy losers, that's going to make you wealthy, right? You're buying the losers, selling the winners. You're making money here. And the thing is, you don't want to buy the winners because they already made money and you'd be buying after that fact that they made money, right? You want to sell the winners because it means that you made money out of it. And you would want to buy losers because it doesn't matter if the loser was, or if it was a loser before you bought it. All that matters is that it becomes a winner before you sell it, right? Think about it like that. I know it might sound crazy. And here's the thing that makes reallocation difficult is that emotions will get the best of us, right? It's going to make us act against this because our psychology makes us want to buy the winners and avoid the losers. It's just a self-defense mechanism, right? But failing to reallocate will make you own nothing but stocks. Remember the previous example, how stocks grew the most. You would in your head would think, oh, I'm going to just keep buying stocks. But that's going to defeat the whole purpose of diversification, right? To protect us from the different risks, right? If you keep on buying stocks and only stocks, now you're so prone to market risk that if anything bad were to happen, there goes your portfolio, right? So a model portfolio will change over time based on circumstance, right? It doesn't always have to be that even split like in our example of 25%. Maybe over time you want to shift away from stocks and move to bonds or US government securities and whatnot. So 2 ways to reallocate your portfolio. First is by time. So you would just pick a date on your calendar or just a period to rebalance. So many people choose to do quarterly, which is every 3 months, and it's just a very popular method. And your employer retirement plans allow for automatic rebalancing by date as well. So that's just further reason why more people just choose to do by time. But there's a key disadvantage here, and it's that you may rebalance when you don't need to, or you're going to rebalance, or you don't rebalance when you need to, right? So what I mean by this is that let's just say a stock, right, that you own jumps up, but that's right after you already balanced. So you rebalanced, and then right after that, the stock jumps up. You totally miss an opportunity to lock in profits, right? Or you're gonna have to wait that entire quarter just to, sell that winner now. So overall, when you do it by time, it's still good because it's periodic, but the problem is that you can't choose when, right, to lock in your winners, essentially. So to solve the problem is to do by percentage. You rebalance when an asset class drifts outside of a range. So let's look back at our old example, which was that 25%, right? Let's say if stocks were to move to 28% or move down to 23%, you would rebalance it. And this reduces the volatility and investment risk in your portfolio, and it improves your returns as well. And this is a much better method than doing it by date or by time. But the problem is that it's going to require more effort because you're going to have to check your portfolio daily or very periodically, right? So that you can check those ranges. And now let's talk about the whole buy and hold thing. A lot of people say just buy and hold, but that strategy is flawed because we know market timing doesn't work, people just resort to buy and hold. But the thing is, holding will make you miss out on profits and become out of balance, right? If you just buy and hold, you're just going to own primarily stocks or bonds or whatnot, and it's going to be not diversified, right? Your portfolio is not going to be diversified. So long-term effective investment strategy or management is just buy and rebalance. Okay, buy and rebalance, not buy and hold, buy and rebalance. So recapping everything that we learned. First is that diversification requires you to split your money into different asset classes, and that rebalancing or reallocation works because you buy the losers and sell the winners, right? That's going to make you wealthy. And that you can either rebalance by time or by percentage. Remember, time is more convenient, but percentage is a bit more effective and requires more effort. So just pick whatever one you want. But rebalancing is still important. Just make sure you do that. And that buy and holding is just a flawed strategy, right? Because you miss out on the profits and become out of balance. And that what's a better strategy is just called buy and rebalance. So that's it for the video. Thank you guys for watching. Like, subscribe, do what you will. You guys are not obligated to do so. And I'll catch you guys in the next one. Peace.